Hi, welcome to Market a Minute. So we had this indicator called the death cross. It's when the shorter term moving averages cross the long term moving average. And I'm going to walk you through that and really put some numbers around it so you can understand why it's important or not. And then we have some black swan thinking. Black swan is something that's rare. And, we are in a rare period of time currently in what's going on in the markets and policy. So I want to talk about kind of things that could happen. And then the dollar needs to hold. So it really needs to start gripping here. So before we start, I want to tell you a funny story. I'll be really quick. So we have a president that says whatever's on his mind, right? It just comes out. He can't help himself. So one of my friends and his wife, this is many years ago, at a golf outing, a charity golf outing out in California. And they sat at the same table as Trump. Trump sat across from them. And Trump would go, "You're with him," the wife to the husband, "You're with him." The wife was just beautiful, right? She's a beautiful gal, 20 years younger. And he's not a good looking guy. Overweight, not good looking. And Trump just couldn't get over it. So we've had some personal experience with Trump. He just says what's on his mind. And we think he's right about Powell, but he just ought to shut his mouth for a little bit and just do what he does over time and not make such a big deal about things. So the technicals of the market. So this is the 200-day moving average here, the purple line. And you can see the green line is the 50-day. So when the green line crosses the 200-day, that's called the death cross. The death cross is something that happens. By definition, you can't have a wicked bear market without these moving averages crossing. And so it's happened in every single major bear market. So technicians watch this. And so going back to 1928, so we had the average number of days after the death cross occurs before it bottoms out is about 140 days. And the mean decline for that point is about 13%. So that would be down around the 4,700 level, be way down here. Somewhere down here is where the markets would likely bottom out if I did that math right. So it's got some more downside and it's got some more time on its hands. So in March 22, okay, you remember 22? That was not a good market. So the market corrected, we had a bear market from high to lows, probably 27%. But when that death cross occurred, it declined another 12% over the next 6 months. And then during 2023, we had a death cross occur. And so there, we had another 8% decline, but after 6 months later, it was 9% higher. So net kind of, we had volatility. And then of the past 20 death crosses, okay, the last 20, the market was higher 1 year later 80% of the time. So you can see there's kind of a little bit of mixed results with the death cross, but it's important to know and just keep this in mind. We are in an unusual period, and there's the technicals do not look good. What we want to see is we want to see the 20-day probably lower, but the 50-day and the 100-day to move clearly lower, so they're below the 200-day. So it gets washed out. And then as the market starts to go back up, starts to break the 20-day, you incrementally get more invested. The market, kind of feeds on breaking through these shorter term moving averages as it goes back up. So we see this kind of as an opportunity. Obviously, we're protecting our portfolios in a number of different ways, and I'll talk about that. But we see this as an opportunity. As these moving averages come down, it sets up for a nice rally, and you have some good fundamental things that are going to occur in the second half of this year. So black swan thinking. I don't want to get too negative, okay? I don't want to put myself in a box and be stuck being negative. I want to take advantage of this. So looking at the 5-year chart of the dollar, okay? Here's the 5-year chart, and we're at a support level. We need to hold this support. If it doesn't, maybe there's a little bit of support down around here, maybe a little bit, but we're at least 10% lower, if not more. If that would occur, the markets are heading much lower. So just keep in mind, these are unusual times. It's similar to 2000 to 2002 or 2007 to 2009. These are unusual periods. Could we have a 50% decline? Absolutely. So I would just think in terms of buy that stock when it's down twice as much as you expected. It's probably safe to get into it. So the markets were down twice as much as people expected during that 2007 bear markets. So AI is not going to save the day. AI is like any other excess that has happened in the past. So we had a tech bubble in 2000. We had the housing bubble in 2007. So this is nothing unusual to cleanse out these excesses. So AI is going to be around, but it got to an excess. So that's part of the problem we're having, is not just the tariffs, but it was really high valuations because of what's occurred in the technology space. Now, Apple, if things don't go well with China and the tariffs, most everything's made in China. Apple could be down another 50% from where it is currently. And NVIDIA, if China would go after Taiwan, NVIDIA could go down another 50%. So these are unusual black swan events that could actually occur. Now, talking about China a little bit, if you put 145% tariffs on China goods, what do they have to lose, right? They're at a war they can't win on economically. So why not just blow Taiwan up? So we don't think they're going to. We don't think that their military is up to it at this point. Be too much to overcome, but you never know, right? And the tariffs and Trump and everything else that's going on, you have Russia still out there lingering. As I mentioned, China, Iran is in focus. Maybe that gets resolved well, but there's a lot of things could swing the other direction and not go the right way. What killed the market in 1987 was the dollar. So if this dollar falls, we could see another probably easy 10% drop in the overall markets. So the dollar crushed 1987. It could crush this market. Just keep in mind, here's the numbers. Foreign ownership of U.S. stocks is roughly 20% of the market. That's a crazy large number. That's $16 trillion. So if the markets are down 17, okay, and you add another 10% to that, so they're down 27% because of the currency translation. That's a big number. What are you going to do if you're a foreigner? You're going to get your money back out. And then NVIDIA is down about 37% from its high. Add 10% to that because of drop in the dollar. That's a 47% decline in NVIDIA. Probably big tax loss selling in that stock for foreigners. So the foreign markets, the foreign money is a big part of our overall markets. And if the dollar continues to fall, it's going to be a problem. Powell, should he be fired? Our opinion is, yeah, it should have happened years ago. To do it now, it doesn't make much sense. He's got less than a year left, or roughly a year left in his term. So look at this. So this was right here. This is COVID. Okay, we're through COVID. We went from the balance sheet from 4 trillion up to 7 trillion, plus the rates are at zero, plus Biden's going crazy with all sorts of spending from the federal government. I think that was around 9 trillion he spent. And then, Powell keeps it going. He just keeps it running after we're out of the issue. And he did another $2 trillion. This is malpractice. Okay. And now it's rolling over. He's letting the balance sheet run off. That's causing interest rates to be higher than what they should be if this wasn't occurring. He's allowing, still doing $5 billion a month in treasuries, but he's doing $35 billion in agency and mortgage-backed securities. That is a lot of money for the housing market to absorb. So why is there such a large spread between treasuries and mortgage-backed securities? They're really attractive. We love those securities. We love the agency debt REITs that yield 17% or higher. The spread is so high because of what's going on with the Federal Reserve. So it's difficult to afford a house because interest rates are so high because of what the Fed's doing. Now we're in a recession, probably. We'll see on April 30th if we are or not, if we have a negative quarter of GDP. And he's still letting this run off. He's got to stop. And so the bond market's also mainly concerned about the $10 trillion of debt, treasury debt that needs to be financed in a very short period of time this year. And at the same time, we're letting that balance sheet run off. So it's compounding the problem a little bit. So $10 trillion is not a small amount of money, but if you add to that roughly another $500 billion because the balance sheet is shrinking, it's all overdone. So, the Powell is probably not the right guy. And, Trump's saying this guy's a loser. Hard to argue with some of those comments, but he should just keep them to himself and do what he's going to do. I think the markets will support a new person running the Fed, but it sure will be a shock if that occurs. Market update. The banks had good numbers. I was very impressed. Their loan losses are in check. They're well reserved. Earnings were strong, very strong, and the valuations are terrific. The bank stocks have corrected in a big way versus for their valuation. The valuations are really attractive. You can buy Citigroup. I think Citigroup's like at 6 times earnings, and good trends. So we like the banks. We've been starting to nibble a little bit at them. It's hard to have a big bear market if the bank stocks have good fundamentals. So maybe they'll play out to the negative yet, but we're not seeing a fundamental problem with the banks at this point. We're going to get a lot of earnings over the next 3 weeks. This week we've got Tesla, and then we also have Google, but there's a whole bunch more that are reporting. The companies are not going to give good guidance. They're going to be conservative. We're starting to see the earnings estimates come down. So 2025 earnings down now to $267. We think they're headed to $250. So a couple ways of looking at this. Here's the earnings trend this year. This is consensus. This is way too high. We start to go into a recession. This is going lower, this is going lower, this is going lower. They're all going lower. Okay, so maybe we get 272 in earnings in 2026. And if you look at this, I love this chart. So the black line is the earnings trend. The blue line is the S&P 500. And so stocks follow earnings. And sometimes they get ahead of themselves and sometimes they correct too much. But say we get to $250 in earnings this year. If you just do one for one, that gets the S&P 500 about 4,500 on the S&P 500. So we're 5,100 now. So we're off, that'll be off over 10% from that point. That's pretty consistent with what we told you about the death cross. Now, valuations, as we talked, the S&P is roughly at 18 times. That's not bad. That's getting there. Now, the S&P 600, so you can see smaller names, right? We love smaller companies. They're setting up. They're starting to get there, roughly at 12 times earnings now. And so coming out of a recession, you get these big valuation increases in the small names because the fundamentals are really strong. The earnings are really growing at a very rapid rate coming out of recession. This is starting to set up. So we think it may go down another 20%. Who knows? But they're starting to set up, and at some point we're going to go into this area in a big way. Now, risk management. Just keep in mind, okay, the last move down, don't get there too early. You could dollar cost average in, but the last move down is when you get the big flush. So that's the last month of the bear market is usually the worst. And so as we go through this year, we're gonna get a flush. We're below the 200-day. Say we have 9 months from when that occurred. We're looking at the latter part of this year, probably be sooner with all the stimulus coming that Trump's going to do. So think in terms of maybe it's September-ish when the markets are seasonally kind of tough. We'll see, but we will know when we get there if we're at that bottom point or not, and the technicals will set up. The recession, we will get the GDP report April 30th, as I mentioned. We're likely going to have 2 back-to-back negative quarters of GDP. And when the Fed is forced to cut, rather than they cut because they can't, because things are good and they can't cut, but when they're forced to cut, when somebody has a gun to their head, all right, that's generally, it takes multiple cuts before the market to finally react to that. The Fed meets in May, June, and July. The way Powell thinks, we don't think May's probably going to happen, but it might. Maybe he's spooked by that negative quarter GDP and doesn't want to hear Trump saying he's a loser. But anyhow, we're not sure that occurs in May. Likely to occur in June. Likely to occur in July. Likely set up the rate cycle so we get this money, all this money that's out there. Look at there's almost $7 trillion in money market funds. So the money market funds went up by about $1 trillion in the past 12 months. This is a lot of money. It could move the markets, could offset any sort of selling from foreigners. Lots of money to fuel the next bull market. So just keep that in mind. When the bull hits, it's going to be a strong one. And then we're going to get the tariffs going to be behind us. They still may be around, but it won't be the headline every day. And then the tax cuts will hit. That'll likely happen sometime this summer, probably be retroactive. And the deregulation will be great. And I'm a little surprised that we're not seeing more federal spending cuts. So maybe that's still out there. So maybe there's a little bit less hit to the economy because of lack of federal spending cuts. We really need to bring down the budget deficit in a big way to balance things out. So again, plenty of cash out there to fuel this bull market when it does occur. What we're doing, cash, stop losses, and hedges, okay? So just keep in mind at most of our positions, we have a stop loss in place, and we're letting in the cash drift higher. Names we like, we're dollar cost averaging in, and then hedging. Hedging is so important. So if the market's down 50%, we don't want to be down 25. It's okay to be down 5% or maybe 10, but not 25 and certainly not 50. So what we're doing in our portfolios, we're protecting the downside with inverse ETFs. Like on the S&P 500. So when the market drops, those inverse ETFs go up and protect our portfolios, the stocks that we want to keep in the portfolios. And we're actually using at times some levered ETFs, And if you would like to talk to me about the risk of using levered ETFs, I'm happy to discuss that with you. But this allows us to use less cash to get that hedge in place and keep some of our securities, or put that money into higher yielding, treasury notes than just keep it in cash. So if you have any questions, just ping me. Come to my website, Patrick Adams CFA. Sign up for a hard copy of Market in a Minute. We'll send that to you every week. And if you need help on managing your portfolios, I'm a loss-averse investor, but I like to make big money. Come to my website. Send me a note that you'd like to discuss what we do. Take care.